for 2026 for Emirates. We have 15 different campuses that are participating in the challenge and over 300 business students. So it's a very intense version or simulation of the trading market, and we are focused on the US Dow 30 this year. So we began our competition in the first week of June. We did have a slightly delayed start at the request of campuses, so we'll be running for an extra week at the end. So far, you've been allocated $1 million to invest in any Dow 30 shares that you'd like, using the trading platform link, which was in your welcome email. By the end of the month, I will be sending out an update to show you where your investment portfolio falls within the competition, what your ranking currently is, and how much you have managed to invest, how those portfolios have grown as well. Obviously, in order to win the competition at the end, you want to see the greatest growth in your portfolio on that 1 million Rand invested. The next phase will be portfolio management, and that will go until October. So now, without any further ado, if you have any questions for me, please feel free to pop them into the chat, or any questions for our expert, Michael Grobler, our trading maestro of derivatives and equities. A 30-year veteran of both local and global markets, we finally have an investing champion who can mentor our investors through this competition and maybe give them some lifelong knowledge and a skill that could really give them an advantage, particularly being business students. So if you are ready, I will shut down and hand over.
Good morning, everybody. I hope everyone is doing well this early morning. I have a slight flu, so bear with me if I snuffle and cough from time to time, but we'll try to get through this. So we've done this quite a number of years now, and it's been quite a great success so far, and it gets a little bit bigger every year as well. So well done to Varsity College and to Megan for setting everything up. And I'm many students in so many different sections of your business that are getting involved in this little experiment. And last year, the performance was really great. The market was very fun and dynamic. So let's do it all again. From my perspective, what I'd like to do is just chat a little bit about like from your mindset entering the market now. Some of you will have done this for some time. Some of you will not have done it at all. This might be how you are, your first taste, your first toe dipping into markets. Maybe this is the way you are doing it. You're one of the 300. Some of you are coming here to want to get some sort of like greater insights. You've played around, you've got easy equities accounts already or whatever. Some of you, I mean, the young people today are very financially, they're very economically active compared to people from the past. Previously, people got a job, then they started the whole buying the house thing, and then there we go. Pension fund, 1, 2, 3. Now people have Bitcoin, and they have all sorts of new technologies, and they've got instant access to commission-free trading in any security, any asset. You can trade the news, you can do whatever you want. You've got South Korean derivative traders borrowing money from the banks instead of putting money into houses. So you've got entire generations that have you've got a whole generation of guys between the ages of 20 and 40 who believed in the crypto concept. And they are waiting for that to work out. That was their investment. Maybe it will, maybe it won't, but that's what they went with. It's a lot more risky than what Grandpa did, but it's also a lot more rewarding potentially. And it also is a big indication of how much pressure people are under at the moment to excel and to stand out and to, they have to experiment in things which ordinarily wouldn't be a place they went to, because it wouldn't be justifiable under most circumstances, but today it is. People have to do some pretty pull all the stops out to just barely make a living, never mind thrive. So the trading community is about 50% men, 50% women, and it's made up, that's why they call them equities. And then so we've got a situation where people will enter markets for an assortment of reasons. They will either be a young person looking to build wealth over the long term, or they will be someone who's hit a wall and needs to find a way out. They need some exceptional solution. So they look for an exceptional solution and they find it in markets. You've got a large demographic of South African women who trade, being live-at-home moms, being a mechanism by which that they can make pretty much any amount of money that their skill will allow them to on the market. A lot of people using it as their side gig, because everybody's got to have a side gig. Just reading a quick question. Okay, I see. So yeah, I want to help you understand the fact that a lot of these people who go into markets, they go from a complete position of ignorance, and now all of a sudden they've got to compete with, some really well-capitalized, well-educated, very experienced individuals. And it's very intimidating to think of having to do that and to go in and to actually thrive, because I don't just want you to go into the market and win the competition. I don't just want you to all do fairly well in the competition. I want you to learn during the competition how to trade, how to invest in markets. And when you long from now forgot this competition, you will still be trading, and you will still be using that edge in society, because we're going to talk about the edges that you need to have today. And one of the primary edge is just having found the market, because that's where the money is, let's be honest. So you've already got an edge over your fellow man just by being the kind of person who logs into a meeting on Saturday to learn about the stock market. So today I would just want to talk about a few of the basic principles of investing and how they relate to the fact that you don't need to be too intimidated when you enter markets based on the position you consider yourself to be in currently on a competitive basis in the market. So you'll have to bear with me through a little philosophy, because the difference between people who thrive and fail in markets is how they think. It's not what they know necessarily. It's not what they have. It's not even the experience. It's just how they think. Investing, and particularly trading, it is a thought process. If you react to different events in different ways, you will have different outcomes. How you think is the filter by which you determine how you will react. So I would hope to teach you to think differently, to try not to think in a competitive fashion, to try not to be in a rush. These are the things that the experienced people have learnt. This is why they are dangerous to you in markets, because they understand how to think. So if we're going to get you into a position where you can thrive in markets now, immediately in the competition and moving forward, we need to make sure you understand how to think. So let's start with a little bit of a long-winded piece of philosophy. You'll just have to bear with me, but I hope it will make sense in the end. It is the first principle of money, and it relates to an abundance mindset. And I'm not talking about some happy, clappy, positive attitude nonsense. You can have all the positive attitude you want in the market, you will get crushed. But if you have a creative mindset, that is completely different. And that will also move through your entire life and add value. So let's begin. Thought is the only power which can produce tangible riches from the formless substance. The stuff from which all things are made is a substance which thinks, and a thought of form in the substance produces that form. Original substance moves according to its thoughts. Every form and process you see in nature is the visible expression of a thought in original substance. As the formless stuff thinks of a form, it takes that form. As it thinks of a motion, it makes that motion. This is the way all things were created. We live in a thought world, which is part of a thought universe. The thought of a moving universe extended throughout formless substance, and the thinking stuff moving according to that thought took the form of systems of planets and mountains that form. Thinking substance takes the form of its thought and moves according to the thought, holding the idea of a circling system of suns and worlds. It takes the form of these bodies and moves them as it thinks. Thinking the form of a slow-growing tree, it moves accordingly and produces the tree. Through centuries those centuries may be required to do the work. In creating the formless seems to move according to the lines of motion it has established. The thought of an oak tree does not cause the instant formation of a fully grown tree, but it does start in motion the forces which will produce the tree along established lines of growth. Every thought of form held in thinking substance causes the creation of the form, but always, or at least generally, along lines of growth and action already established. You must get rid of the thought of competition. You are to create, not to compete. You do not have to take anything from anyone. You do not have to drive sharp bargains. You do not have to cheat or take advantage. You do not need to let any man work for you for less than he earns. You do not have to covet the property of others or to look at with wishful eyes any man's properties. No man has anything of which you cannot have without taking what he has. You are to become a creator, not a competitor. You're going to get what you want, but in such a way that every other man will have more than he has now. Now, when you go into the market, you must remember that it is the thinking substance. Try not to see the future in the markets and try to think properly. Learn to expect things to happen, but not to predict them. If you become a very, 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 very good contingency planner, you will find quite quickly that you can respond to events almost instantaneously. And because you've already considered all the possibilities, instead of just focusing and predicting one, you can get off the mark so quickly, it almost seems as if you false started. So if you think properly in markets and you learn and you build that oak tree, and you're able to expand your knowledge year after year and month after month and week after week, even in this immediate competition timing, you can begin to consider enough futures that when an event takes place in the real world, you'll have a plan when the day comes. The point of learning in markets isn't to be able to tell the future. The point is to be aware of everything that you need to consider in order to react to any reasonable outcome. And that is definitely achievable. If you spend your life trying to figure out what will definitely happen in the future, and you're wrong, you'll be wrong, because you'll be wrongly positioned. We call it wrong-footed. If you have an open mind, you take the information in as it comes, unemotionally, having already considered the likelihood of this taking place, the implications of what had taken place. You won't get emotional. You'll stick to your systems. You'll be more reactive than preemptive, which will be appropriate at the beginning of your trading career, particularly. And you won't have a competitive mindset. You won't feel like you're in a rush. You won't feel like you have to take anything. You won't get angry with somebody if they trade against you. You won't get angry about the news. You've got to suppress your emotions, but that's an impossible thing to do. So you have to remove the need for them in the first place. And all the reasons why traders make mistakes, they rush, they do revenge trades, they do all sorts of funny things. They go in far too big, far too fast. None of these things would happen if they had the right way of thinking. That doesn't require 10 years of financial education. And if you have the right way of thinking, if you're not competitive, you're creative. If you're just learning, building, and expanding the different variables that you're able to consider whenever we walk into the next crisis, and there will always be another one, your mind will be a blade that's ready to cut into markets. But if you go in there, well, this must happen. Crypto will fail, or crypto will succeed, or if you find yourself to be a maximalist, they say, on any issue, you need to just check yourself. So when you go into the competition and we get involved in stocks that in this market are moving in very big, very, very major movements all over the show. We've got AI bubbles, we've got SpaceX, we've got well, you might not think the AI is a bubble. Maybe it isn't a bubble, but certainly the media argues this. We've got chip makers. We've got Asian stock markets in China are down 50% from their highs. Korean stock markets are doing like casino level numbers, 5 times the performance of the United States, because they have 2 of the largest chip manufacturers in the world. RAM and chips, Samsung. And it's just a very, very busy and volatile market. So in order to help you think correctly, we're going to go through some of the most basic mathematical principles that affect markets. And the nice thing about them is they're very consistent and tangible and quantifiable, and they're not like, I wonder if the stock's going to go up. I'm going to have to feel the vibe, These are just a wonderful starting point. They are tried and tested academically throughout thousands of years, and they're undeniably helpful just to have sort of a broader framework of the mathematics of markets, because we could talk, we've spoken previously about things like technical analysis and fundamental analysis and sentiment. And now these are all very important things, but they still remain derivatives of stocks. Stocks are made of numbers. Numbers are not feelings, so they're not sentiment. They're not fundamentals. That's money. Fundamentals are cash flow. They are revenues. That's money. That's business. It's one level of a higher evolution than the actual mathematics itself that guides the stocks. So the stocks can only go up and down. In other words, let's not think about them as stocks. Let's think about them as X. So there are 4 pillars in trading mathematics, and they are statistics and probability, linear algebra, time series analysis, and risk management. Now, they're not as hectic as they sound. The most important one by far is risk management. But when you look at a chart on the exchange and it looks a bit, all over the show, who knows? It looks simple, but the percentages have changed, the movements have changed, the range in which it trades has changed, what 5 points value is worth in percentage terms has changed. So there's this enormous matrix of variables inside that chart that's very intimidating unless you understand the language of the chart's formation. So let's start with basic statistics and probability. Just so you can sort of get the feel for a lot of the tools. I mean, a lot of you will use indicators like 200-day moving averages, basic technical analysis, momentum indicators, DMI, ADX, etc., etc. They're literally innumerable numbers. And some of them are quite useful. Some of them are backward facing, some of them are not. But the funny thing about statistics is the way statistics works is you can take 3 not so good things and put them together and get a really great thing. Now, that doesn't really work that way in real life, but in statistics, it certainly does. So it's more about the framework of your analysis than the individual items in your analysis. And it's how the different components of your analysis relate to each other. So every price is a signal that represents the truth. And then to that, you add some randomness. Only we don't know how to discern between the randomness and the truth. So we get what's called noise. Statistics is the toolkit that separates the signal from the randomness. That's what statistics is. So the most basic aspect of statistics is something called the law of large numbers, which you may have already heard of. If you ask 5 people on the street whether they like McDonald's and all 5 say no, that doesn't mean that everyone hates McDonald's. You haven't asked enough people to get the true reflection of what you're trying to understand. If you asked 5,000 people, that would be pretty decent. But you could also ask only 5,000 people who live in the absolute poorest section of Port Elizabeth. It wouldn't be very clever because they probably wouldn't have money for McDonald's. So you need to ask 5,000 people in every suburb. Okay, now we're really sure we know that nobody likes McDonald's. So the more people you ask, the more likely you are to get a true reflection of what those people think on average. So bigger samples, more accurate results. So if you want to look at an idea that you've got, or you've got a theory about stocks or something, look at a whole hell of a lot of different examples of what you're talking about or what you theorize. And go and have a look and go and test your hypothesis on that, and then on another one, and then on another one. Because especially if you know anything about a casino, if you go into a casino and you bet 5 times, you win 5 times, you think that's how casinos work. Not at all. They use the law of large numbers against you because they just moderately modify the odds in their favor, and then they just churn revenue, volume, and then the math comes and just gives them the money. And so you can reverse those laws and benefit yourself in markets by just taking the time to do a decent sized analysis. Don't just look at 1 or 2 stocks when you have a theory. Look at a large number of stocks You don't have to do this every day, because if you trade regularly on if you trade in the game regularly, or if you trade in real life regularly, you will constantly get exposure to this, and you will eventually start to formulate a view where your mind becomes a measure of large numbers in various areas. So that's one of the reasons why experience in anything, never mind trading, but life, your parents have just seen what you've seen 5 times more, and they've got a better idea of how it really works in real life as a result. It's not an indictment on your youth. It's just how it works. And there's no way to get to big numbers unless you're old and wise. You know what I mean? So don't backtest 10 winning strategies. Do hundreds and thousands if you can. This is also how some of the large hedge funds, just by virtue of their size, gets an advantage. They just do such large analyses that no one else can do a larger analysis, so they get to a more refined number than the rest of it. Excuse me. Okay, so then you get your central tendency. So this is a very important part of statistics as well. It's one of the most important parts. It's the basis of diversification. So you've got three sort of versions of central tendency. You've got the mean, which is just the average. And then you've got the median, which is the middle. And then you've got the mode, which is the most common entry of the batch. So just be aware of that fact. If you have 20 shares in your portfolio, you're going to have a lot less volatility than if you have 5. And your results will be a lot more predictable, because you will have just a lot less hyper focus on individual components of your portfolio. All right, so then you get standard deviation. Standard deviation, especially obviously in markets, is very important. Just putting it very simply, if you go too far in the one direction, you're going to come back. What goes up must come down, that kind of thinking, that's standard deviation and variance. It is the foundation of risk at a mathematical level. In finance, the term risk is actually standard deviation or volatility. So in finance, we consider risk to the upside or risk to the downside, which is a bit counterintuitive, but it basically means going off the path of where we expect that standard deviation. There are a lot of rules and laws of mathematics that very much identify and confirm that. It's something that you can really rely upon. It's one of the few constants of the beauty of maths, is that it's the only actual constant in trading. You talk about sentiment, you talk about all these other edges people have, but they are ultimately always going to be subjective, whereas mathematics is objective by its very nature. Just a second. Okay, sorry. PC freezing up. Okay, central limit theorem. We've done central tendency. So yeah, it's just okay, conditional probability. You can approach the market from a conditional probability perspective. So what we're going to try to do today is we're going to try to determine how are you going to select your stocks, and how are you going to consider how much risk they pose to you in your portfolio. And once you've done those two things, you'll be able to decide how much you want to put into each stock. So you need to know all of these things at the same time. And then once you've given a points value or a weighting to your stock based on your system architecture, you'll be able to buy that stock at that price and that amount with the intention to sell it this much higher, or buy it again this much lower, or close it out this much lower. So you could have a situation where you only buy stocks when the VIX is below 30 and you only sell stocks when the VIX is above or below 15, for example. That's an example of conditional probability. It's just a mental framework like any other application of maths that you would use to determine how you're going to break down your analysis into what you plan to put into your portfolios. Skip page. You will keep we'll keep out of things like scalars and vectors, etc. It won't be relevant to you. Okay, stationarity is something that I will need to tell you about. So a lot of people have this idea in their heads that there's stationarity in markets, and when you do statistical analysis or even just broad strokes on the charts, you'll get a sense that there's some kind of stationarity to the asset. Now, what is stationarity? Stationarity is the idea that if you think about something like our interest rates go between a range of 5% to 15%, call it. Hardly ever goes out of that range. So going through that range, people expect it to top at 15 and bottom at 5. Then a few years later, top at 15 again, or 14 or 13, and bottom at 4 or 5 max, lowest. So the truth is that stationarity is not, it doesn't exist in markets, but people seem to get the sense that it does. So they think that the trade will go up a bit and then down a bit, up a bit, and it might have a slight movement to the upward direction or the downward direction. But the truth is it can blast all the way out of the pavement area. It can blast all the way out of the right-hand pavement or the left. It can go in any direction. It doesn't conform to some sort of pipeline average. And that's what creates the risk of markets, because you could survive any asset that truly traded in a stationary way. It would never really get out of, never go so much above that it made you a billionaire, never go so much below that you went broke. Unfortunately, stocks have no respect for stationarity. They just go wherever they want. So it's just something you must always consider. Do not approach the market with a mindset of like an interest rate stationarity mindset, or like a production cycle for platinum, for example. Well, they'll have big years, and they'll have low years, and they'll have big years, and they'll have low years. But they're not going to have a year and a year from now where they've got 100 times more platinum producers. This is never going to happen. There isn't the physical infrastructure to cause that physical event to take place, which means that platinum production has a level of stationarity. So do car sales. It's not going to be a day where tomorrow 1 billion cars get sold. It's just not going to happen. But stock prices, they can go up by 500% in 1 second. That needs to be something that's very clear in your mind when you're considering risk management. Don't worry about the recent price movement. You must forever think that every price is on the table tomorrow. Every single price that it could possibly be is on the table tomorrow. Now you sit and think, what are the possibilities that could take place with regards to this specific asset that could send it to those levels? Am I prepared for them? Am I over-invested if that were to happen? Am I under-invested if that were to happen? Would it be an acceptable scenario if every scenario took place? Or I feel that this scenario will happen more likely than this, so I'll slightly weight myself to that. But always mindful of the fact that your stock could go to zero tomorrow, no matter how big it is. Never think it's not possible. So this is why diversification also assists with that, because it allows you to make a very committed decision. I'm going to buy the stock, but I'm only going to do it with X value. So now you can make a fully committed but limited decision. So now you limit fallout and limit benefit, but do that on a consistent basis, and you'll do quite well. Sizing is extremely important. It's probably it is the most important part of risk management. If you size your positions incorrectly, you will lose. No matter which positions you buy, even if you buy the right positions for years and years, eventually you will be wiped out by the market. So always remember that there's a rule, I say it every year. You take what you are going to invest, you halve that, and then you halve it again. Then that's how much you invest. Now that might sound like it actually inhibits you, but you have a particular level of wealth personally and in the competition. So that number in the competition is $1 million. So that's your quantum, that's your scale. So every trade you make has to be top down from that, not bottom up from your trade. So you say, okay, I've got $1 million, so I can make, you want to make, say, for example, you wanted to make 100,000 Rand trades or dollar trades. So you knew that you had 10 trades in the bag. So now you know already, before you've spent a single cent, that you've got 10 bullets in the gun. So that will inform how you trade. You can't say, all right, I'm going to buy, I got 10 bullets in the gun, so I'm going to buy every 1% down. Okay, and then if it goes 11% down, no, okay, obviously bad idea. All right, so I got 10 bullets in the gun, I'm going to buy every 10% down. Yep, that would make sense. You could buy the thing right up until the end. And at any point then, if you were right from there on and it moved upwards in a long-term secular trend, you'd be proven correct. Same guy, same amount of money, totally different outcomes. The one guy got destroyed after 11%, the other guy made money after an 80% drawdown. The one guy had $1 million, the other guy had $1 million. So think of every individual trade like that. Not just the whole portfolio's got $1 million. I'm going to put 100 grand into each trade, or I'm going to put 10 grand into each trade. You say, I'm going to make a trade. The trade's only ever going to get 100 grand. How am I going to buy this trade? Okay, I'm going to buy 10 grand every 10% down, or some people would even buy 10 grand every 10% up. I wouldn't. It's mathematically counterproductive. But if you were that kind of trend following trader, no problem. The point is, decide the budget of the trade before you make the trade. The whole budget of the trade from the very beginning of the trade to the end must be decided before you start the trade. Because then if the trade moves in absolutely any direction for any period of time, you will know, no problem, I'm here, that's the amount I have in as a percentage of the total amount. I decided that I was going to spend 100% of this trade's budget over the course of a 30% decline or over the course of a 10% decline. Whatever it is, if you're very aggressive and you feel you're very close to the bottom, you might do 10%. If you're more cautious, you might do a spread of 20 shares, each receiving 5,000 Rand each every 10% down. Now, that would put so many mathematical characteristics in your favor, it wouldn't even be funny. And that person would most certainly outperform. So then you also get something called your Sharpe ratio. Your Sharpe ratio is just a measurement of how you perform relative to other assets and how you perform relative to risk-free assets. It's not too relevant to you guys at this particular time. Just reading a few of these messages quickly, if you don't mind. Just going to share this. green here. Can you see that? Can you see that? Okay. All right, sorry, I just wanted to show you this. This is just the stock market in America. I've given you the basics of just general principles that you guys can use statistically that don't require a lot of foundational learning and also have an incredibly high bang for the buck. Just use general statistical principles in your trading. Don't do mathematically illogical things. Don't get too caught up in the news. Always focus primarily on the logic of the trade mathematically. Then get involved in, I've got a friend, God bless his soul. He did this. He bought SpaceX at, I think, about 115 SPCX. So he came out and he FOMO'd this particular stock. This is SpaceX. Its listing took place a couple of weeks ago on the 12th. And he ran in hearing that it was going to be a pretty big deal, and he bought it over here at 208. So this was just an unnecessary loss that he felt he was compelled or obliged to buy the stock. I'm sure that many, many hundreds and thousands of people made the same trade. I'm sure he learned an important lesson. There's no rush. If we talk about what we had just discussed now, first of all, you see the large deviation from the starting point. This as just a general statistical logical rule, having listened to the principles previously discussed, would already have been a warning sign to you. We'd been like, that's not really how numbers naturally work. They don't just instantly move up in a spike and sustain themselves. That's just not the nature of numbers. So you would have known that this was probably not the best time in the world to get involved, especially since he even had 2 days previously that he had the opportunity. So this had built up an emotional feeling in his heart. And by the third day, he just couldn't take it anymore, and he did it. And then boom, funny how things work out. Now that's how the market works. It is designed to create that emotional experience in you and then take your money. But the language of how you read what they are doing is statistics and mathematics. And then you can understand, you can clearly see, we see what they're doing. If anything, you would have been able to take a short position at the top, understanding that this indicates that there's an extension that is not logically sustainable, and you could in fact have made a profit equivalent to the desired profit of the first guys in the short leg, just by understanding the principles of only a few simple candles. Here we are, back where we started, reversion to the mean. Also, you wouldn't want to put too much money into a stock that has this kind of a range. I mean, look at the absolute range of the stock. You'd have to think to yourself, now, let's think again statistically. Forgetting the actual deviation and the reversion, what about the actual statistical range of this trade? 50% spread between the lowest price and the highest price. Now, let's say you were to look at a stock that had this kind of extended spread. You wouldn't have to put the full $100,000 allotment into this kind of trade. You'd rather want to put, say, 50,000 in, because you know you get about 2% move bang for your buck compared to any good old-fashioned regular trade. For example, if we looked at Oracle. Now, Oracle has pretty epic chart as well. Okay, it's moving all over the show. And then you might think, okay, so we're gonna buy these two downtrending stocks that have recently had a very hard time. Okay, yes, Oracle, boom. Now, Oracle has lost or has moved approximately 40% over the same period as SpaceX, but it's done it. If you're simply viewing the chart, looking at the drop, you will think that these shares are approximately the same risk level. The vector of the fall's about the same. They're both IT related sort of companies. They're both subject to the whole AI thing. Okay, cool. But the truth is, this one's 10% less of a move. Now, if we went to something like Johnson & Johnson, it would be 20%. So, in other words, it would be justifiable if you're dealing with a share that only has a 20% range to put slightly more money in. Whereas to deal with a share like SpaceX that had a very large range, it would be unnecessary to put the same amount in, because the outcome of the trades would emerge in your portfolio very badly weighted. Even though you had the same amount of money in each share, the share's volatility levels are so very different that it wouldn't benefit you, but it wouldn't result in a sort of a calmness to your portfolio or a consistency. It would result in extreme actions in one leg of the portfolio and very little action in the other. So but you've got to be mindful of how you weight your portfolio, because really what you want to do is you want to have a consistent outcome. So you will adjust the amounts you put in larger volatility stocks. You will adjust them slightly downwards, and you will adjust larger investments into slightly more stable stocks that have stable business models. But you do not want to go all in on SpaceX style stocks. In the competition, you're very unlikely to be successful, because you need what's called a parlay. You need to run a succession of wins, which is very challenging. It's like very challenging to achieve that. What you want is a consistent, broad-based group of wins rather than one or two very big wins. So on TradingView, I'm just going to answer this question to make this line. Okay, well, let's do a little basic TradingView sort of, geez, when you believe it, times really running up. It's not going to start a basic idea of, I don't know why this PC is saying incredibly slow today. It's a cool stock. Let's do it, guys. Let's do NVIDIA. Everybody wants me to. Even though it's kind of becoming old news now. And look at that, not so loved anymore. All right. So yeah, we have NVIDIA. So what you want to do is you want to look at your time frame. So you've got the share here. We're looking at a 1 day, which means that each candle is one candle. It's 1 day, 1 day, 1 day. So this is going to be like a few candles here. 1, 2, 3, 4, 5. You can see on Monday it fell badly. Then it went down all week. So not a great week for NVIDIA. To change this to weekly. Now each candle is representing 1 week. So that's NVIDIA's week. You can see, hey, NVIDIA really didn't have a very good week. You could say that this is still an intact uptrend, but it is looking a little bit concerning. So How did I make that line? So here at the top, you get your basic lines like this. There are various versions of them you can use. You can do all sorts of, trust me, it's like being a trader is almost like being an artist half the time, because you spend most of your time just analyzing, because the chart is the mathematics emerged in the form of a line. So it is really, this is just the math. It's a picture of the math of the share. People will say, oh, Buffett will say it represents the ownership of a company. Yes, it does, but it's actually just math. Then we go over here. Okay, these things are like Fibonacci and stuff. Some of the guys who may have looked into this will know that. These are just time cycle analyses. I don't think they will be too relevant for you. This is the really fun stuff. This is a price range. All you're doing is you're saying, what was the percentage return from here to here? Well, 144% NVIDIA. But remember that percentage don't work in the same way in both directions. So if something can go up by 144%, so let's take this thing down and aim it in a downward direction. Go and take the bottom and put it on the new top. And yeah, you can see it's lost 58%. So quite helpful little tool. And then let's go over here. What about if we wanted to do just how long was this? We go to date range, the sideways version. It was 154 days. Just do this quickly. 154 days, but 107 bars. Why would that number be different? Because there aren't the same number of trading days. Only trading days get a bar, not calendar days. Then we've got, if you wanted to see them both at the same time, I wanted to know that NVIDIA did 104% over 56 bars. See, so there you've got both of got the temporal calculation, the time, got the spatial calculation, the price movement, and together got your little space-time continuum there. Then there are various other millions of different things you can use. These are just to mark buy and sell areas. You've got Fibonacci available to you here. A lot of people like to use this. You can either use it that way, or you can determine that you like to use it the other way. Depends on what you believe. As charts generally conform to the same mathematical principles that I've been discussing with you now. They are, over the years, people have discovered them and they've given them names. And, the golden ratio is the mathematics that powers the Fibonacci's that we see here. So some scientist lady makes a discovery. We give it a name. And then people spend a lot of time trying to figure out how to turn it into actionable information. That's what trading is about. It's about figuring out how to move the signal out of the noise. Because then you get your edge, and edge is everything, because everyone's here in the sea of in the golden city. They're trying to make some money, and you need to figure out something that no one else has figured out, or use something that has been figured out in a different way. Or you have to have some other kind of advantage. You have to have better discipline than the next person, or be completely fearless, or be lucky, or and put enough of these things together. And even though each of them individually seems to be very unlikely to help you, combined, they have a very good effect on your life. Just want to discuss one variable with you. Yeah, just remember that when you do ultimately analyze and make your determinations of which stocks you want to buy, and you remember never to use too many correlated concepts. So you want to make sure that the things that you use to make the determination aren't agreeing with each other by nature. So there would be no point in saying, I'm going to buy, like, for example, you're going to say moving average. Another one. Okay. This is a exponential moving average. It's 9 days. This one's 12 days. Okay, you see those two lines are pretty much close to each other now. They are actually very distinct variable sets. The one is the 9-day and the one is the, I think I put in the 12 day. Now you'll go, oh, okay, well, look at those two indicators. For example, let's say you were to take this to mean that the stock had dropped below these two. So it's twice as important, it's twice as strong a signal because it dropped below 2. But I mean, they're virtually the same thing. So it's not really that much of a strong indicator, is it? Because the two things that you're basing it on. Now, what if I made it like 5 of those and they were like right next to each other? Then I'd say, well, that's a super powerful signal because there's 5 of them. You know, well, it doesn't matter if there's 5 of them. How much they relate to one another is what matters. Different is better than more. Even Jim Simmons said that basically that Jim Simmons is a man who started a very successful, the first sort of mathematical trading fund was started by this old man, chain smoking professor of maths. He just said that basically all trading is trying to find uncorrelated assets and play them against each other essentially. And that'll create ultimately a very successful outcome, because if one thing's bad for one thing, it's actually good for the other. Now, if you can think of like sort of quantum particle kind of thing, where you've got it's existing in a state of possibility, not necessarily in a state of definition. So you've got the portfolio, it's got 10 assets in it. If asset number 1 changes, it has an effect on all 9 other assets. Now, the effect that it has on asset number 7 itself has an effect on every other asset. And then since number 7 is now affecting number 3 then has an effect on every other asset. Now, this dynamic process is taking place in trillions of variable ways in your portfolio at any given time, even if you've just got 5 stocks. You cannot conceivably monitor these variables on a real-time basis and try to take actions to mitigate any, any movement into one of them in too much of a direction for your comfort level. You must structurally embed the counter characteristic. If you buy only healthcare shares, that's not a diversified portfolio, even if you buy 150 of them. United Health is the best performing Dow stock since the last competition. It is the only healthcare stock in the Dow at the moment. It has performed very well. There are a number of other companies in the Dow that have performed well, and some incredible businesses. I think in the next chat, we'll actually sit and discuss those businesses individually. We did that last time. Let's do it again. The stocks change, and certainly the situation of the stocks change. There were quite a number of stocks in the Dow that had a great time last time, didn't have a good time this time, and vice versa. So we'll have a look into that. But yeah, sorry, I know it was a bit of a convoluted way to show you, but I just want you to see before I finish off that it's all about how you think. It's all about how you frame your thinking. If you frame your thinking from a logical, mathematical perspective, using legit principles, we're not talking about pie in the sky here. This is not like hope for the best. Even if you're buying something that is like hope for the best, like let's say, for example, you're buying an NFT or some crazy thing like that, or take just an example of something that could really go either way, like say, for example, Ethereum could go either way, or Bitcoin could go either way. You don't want to get emotional about it. It's still subject to the very same principles of mathematics that we've discussed previously. And if you do that while at the same time controlling your emotions and your feelings by maintaining a grateful, humble, creative, non-competitive mindset, there's very little that will stop you in markets simply by virtue of the fact that these two simple ideas, if you follow through with them, they put you into such a strong position. Everyone else is scoring own goals all around you in markets, I promise you. To just have those two general principles down, you will probably do very well in the competition immediately, and in the future, certainly in life and in investments, in love, in money, in all things. Be grateful, think in an abundant fashion. You don't have to take anything from anyone else. No one in the market's trying to take anything from you. Go in there, play the course, learn, and just learn the right things. A lot of people learn the wrong things for 10 years, and they say, I've been a trader for 10 years. I'm like, okay, what did you learn? Did you spend your life learning 90% nonsense, though? That's the problem. How many trading courses did you buy? If you just discern efficiently between garbage and quality, you can learn more than a man who studied for 10 years. You can learn in 1 year easily. If you have a natural tendency to discern useful, actionable information from useless information, you can learn everything you need to trade to, at the very least, be a consistently profitable trader. You can learn that in a number of only maybe 2 or 3 years maximum. And then you will have an asset that will serve you for the rest of your life to an extent you cannot even begin to imagine. The ultimate side gig. Anyway, I hope you guys got some logic and value out of that. Thank you for your time, and I'll see you soon. Good luck in markets. We'll chat about the stocks. It's been super dynamic and fun. Yeah, just don't rush. Hey? When you go in, don't rush. Take it slow. Make sure you take considered decisions, and you've got a marvelous set of assets there. I thoroughly look forward to seeing what the market's going to do. And just one last thing, don't pay too much attention to the whole war thing and the Iran thing and all of these economic things. They seem economic, but they're actually not. Markets actually care more about interest rates and liquidity and fund flows and markety kinds of stuff. Financial stuff affects financial markets. You'll see here that if we look at the market itself, let's just go to VOO, it's like SPY, it's simply a US market index tracker. So we've been going back and forth in the Iranian war now since 108 days ago. Okay, so what's 108 days? About 3 months. So June, May. Okay, so this is what happened during the Iranian war. So that's how much markets care about war. They'll tell you every day, oh, the market's going to come down because of the war. Markets don't care about wars. Markets are bigger than any war, bigger than anybody, bigger than Trump, bigger than Iran, bigger than everybody. They don't care about this stuff. The only thing the market cares about is will this affect inflation? Will this affect the oil price specifically? Not there's general chaos in the world, markets must come down. No, 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 no. Markets don't work like that. The market must have, the real world event must create a financial asset related impact that then impacts the market, because the market is a financial asset. The market doesn't care if a tank drives into this and that. It is made of money. And only, therefore, if you live in the dimension of money, like people can touch your skin because you live in the physical dimension, this thing lives in the financial dimension. So if you want to affect it, you have to do something to it financially. You can't just blow up a bridge. What did blowing up the bridge do? Oh, the bridge was to a giant oil refinery. Oh, okay, the oil refinery is going to cause the oil price to go up because it's not going to produce. Okay, what's that going to cause? That's going to cause inflationary pressures. Oh, okay, that's going to then cause the Federal Reserve to increase interest rates to cut the inflation. And boom, there goes the market. Because the market doesn't like high interest rates, and interest rates are a financial variable. And if you can't do that whole connective sequence, you're going to look here and go, why does the market keep going up or down or this or that? Because the war and the this, and Trump said it's over, but then the guy came out and said, you see what I mean? You're just going to end up absolutely nowhere. Only see the financial variable affecting your stock, your market, etc., etc. A good example of this, if there are any SaaS companies that are actually on the stock exchange in the Dow, SaaS companies are stocks that have been basically destroyed recently because there's an impression that things like Claude Code will destroy the need to have them. Software services companies, so things like PayPal, everything that you can think of that's software, Adobe, HubSpot, ServiceNow, there's thousands of them, but it's a very large sector in America, and it's filled with many of those stocks. And that sector has been very badly sold off. And there's this real world idea, that this AI, and we're using the AIs, and everyone's using the AIs, and everybody thinks that everybody's going to go bankrupt, and nobody's going to need this company, and nobody's going to need Adobe anymore, because anybody can produce a design platform now. Anybody in his house can do it with Claude Code, and him and his dog, he's going to produce the Adobe AI infrastructure. And then you go and look at Adobe's financials, and they're still immaculately good. Growth in every area. Now, you look at the stock price, and it's been wiped out. So now, this is how you find opportunities in markets, because, okay, the AI is this real world thing. Okay, so where's the financial connection? What's the little blood vessel that led to the actual financial impact on the financial asset of Adobe? So the assumption is that the financial connection is a drop in revenues as a result of the AI. So the AI exists. Okay, good for the AI. So does Claude Code, good for Claude Code. But how does it hit Adobe? Okay, what's happening is that Adobe's revenues are falling, and revenues are financial metric. They're falling because of the AI. Okay, that's why the stock's falling. But hang on, the revenues aren't falling. Okay, maybe we should buy Adobe because the financial connection that's theorized to exist doesn't. And that's what sees the stock ultimately rise, because it fell without a financial connection is exactly as good as our previous example where we said, if the market doesn't fall, if it doesn't have a financial connection. If it does fall and it doesn't have a financial connection, it shouldn't have fallen. It shouldn't have fallen. Now, this is are we looking at the market and we're saying, is this justified based on true, legitimate financial reasons, or is it just news? That is what you did there. In one situation, you refuse to miss out on a rally because you refused to accept simply that the headlines were sufficient to drop the market. So the market ended up rallying. And you didn't see any connections yet to what the war could actually damage the market. Then, just last week, for the very first time, they have a very big inflation number come out in America, and now we're coming down. Okay, so now we've seen that after this entire period of time of the war, now we finally see the first financial impact, and down comes the market. But you missed the whole rally because you thought that the war had to be a reason for the market to fall. So you watch the real world event and then you wait for the financial event. You do not make your actions based on the real world event. So the same thing is happening here with Apple, for example. They're busy doing things with their phone prices and stuff. I want to see what the financial impact is on the company. Maybe the chart dropping too much is not justified. Maybe it is, but always search for the financial connection. You can only speak to stocks in money. You can't speak to them in war and philosophy and politics and geopolitics. They don't speak the language. They don't live in that universe. Okay, guys, sorry, I was going on about that, but yeah, all good. Have a blessed day. Keep playing, stay focused, and yeah, you're about to have a lot of fun if you've never done this before.
All right, perfect. Thank you everyone for joining us. I promise to get to turn this off. Okay. I promise to get to all of your emails this week. We're finally